I am Piers, Ridyard, CEO of the decentralized finance protocol Radix, a public ledger entirely dedicated to bringing DeFi into the mainstream. This is our podcast, the DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I'm joined by Amber, one of the founders of Alliance Block. Alliance Block is building the world's first globally compliant decentralized capital market. Amber, thank you so much for coming on the show.
Thank you, Piers. Always a pleasure.
So what does that mean? Globally compliant, decentralized financial market? Like, just break that apart for me and just tell me what the idea behind Alliance Block is.
Well, our background is in banking, and one of the main issues we had in banking at the time, that was 2017, 2018, was finding a way to be automatically compliant to the various regulations in the various countries. And well, as you know, regulation is one of the big pain points that we have in the DeFi space at the moment. So the platform that we are building, or the protocol, to be more correct, the protocol we are building is inherently globally compliant, meaning that the products and the actors abide by the various rules of the countries that they sit in.
Okay, so but let's take the idea of a DeFi protocol like Aave, right, where I have this idea of collected liquidity, and a individual actor can come along and access that pool of liquidity, and that liquidity could be from anywhere in the world. And because it's a non-custodial, like, anyone can to connect their Web3 wallet and stick some ETH into the ETH lending pool. From a jurisdictional viewpoint, that starts to get quite complicated because they got multiple actors within a program that isn't jurisdictionally bound. There is you don't say, oh, the jurisdiction of this is this, and it's an accredited venue for exchange or anything like that. It just is a pool that I could be taking a bit from basically everyone that's in the pool. So how do you guys think about what does globally regulatory compliant means in the context of like a DeFi, a set of DeFi tools or primitives?
So first, I need to specify something. So there is one part of the business that is fully decentralized and fully focused on non-custodial and decentralized actors. And then the second part of the protocol is focused on institutional clients. And as you know, institutional clients cannot access DeFi for, I would say, two main reasons. One is infrastructure, and the second one is regulation and compliance. So for an institution to access, let's say, a staking program or to access a liquidity pool, the institution needs to make sure that, as you said, all of the actors within this pool complies by the various regulation this entity has to be subjected to. So how do you do that? You do that by using something that is called a Trustless KYC AML. So you're not obliged to go through it, because there will be pools that are for institutions and pools that are fully decentralized. So the pools that are for institutions, if you want to participate in them, you will need to go through a Trustless KYC AML process, meaning that you will have various actors that are renowned actors. For example, we have a partnership with GBG, which is one of the largest company and the oldest company in the world that does KYC AML. So what this company is going to do is basically give you a profile that would be owned by you and that would only be able to be unlocked by you. So once you come into this protocol, the system on top would know where you have been validated. It doesn't mean that the institution will know who you are, but the institution will feel comfortable enough because it knows that it has been validated by GBG previously, or it has been validated by the third party that they work with. So the idea is to have multiple third-party validators These third-party validators can be KYC AML companies, as they can be, legal entities and others. And you will basically be verified, let's say, by one, two, three, four of them. And let's say number five and six didn't verify you. If you're an institution that only works with five and six or require approval from five and six, you will get a red light saying that, in this pool, there is someone that doesn't comply with what you have requested. And hence, it will tell you that, well, it is not in your interest to invest in this pool.
So does that mean that you expect to have sort of lots of little bits of liquidity rather than like large amount, so because each pool could end up being quite specific? Because like I've decided that GBG, is that right?
Yeah.
GBG is good for me, but someone else has decided that it's not, and actually I'm not comfortable if it's done by GBG. I'm only comfortable if it's done by these guys because of my local regulations. Does that mean that it's quite likely to be fractured liquidity?
No, because we want to have all of the big players in the KYC AML third party verifications, and hence you would end up with everything being covered. Now, keep in mind, the way we are visualizing this to happen is basically you will have pools that are specific for institutions, because I mean, how the DeFi world work, and that you will have very few, let's say, crypto enthusiasts who, in my opinion, will find it beneficiary for them to enter into these kind of pools. So here you will have a sort of a segregation between the institutional pools and then the more retail kind of pools. And this, in a way, even can make institutions more comfortable because they will be facing institutions. So institutions facing institutions. And in a way, this will create actually very large pools, because an institution is not going to put in, a $1 million ticket. They will be putting in a much higher amount.
So like this is the idea behind this, I suppose, is to bring the DeFi. Like, what is it that's exciting about DeFi to institutions? Like, why are institutions looking at DeFi and going, man, I really want to be in that? Like, what's drawing them in?
Well, the first thing that is very obvious is yields. I mean, if you're following a little bit what's going on in markets, today we have the 10-year yield at 1.30%. It's ridiculous, yeah? Junk bonds are trading at what, maybe 200, 300 basis points spread above treasuries. That's very, very low. You saw yourself how MicroStrategy issued a bond, a 7-year bond that was yielding 6.75%, I think. And the bond was oversubscribed. They wanted to issue 400. They ended up issuing 500 million because they were offering this extra yield. So institutions are running for yield in a world where yields have been like completely smashed. So when you have products that can offer you on, let's say, on USD stablecoins or on more stable cryptocurrencies, a yield of 20% per annum, this becomes interesting. It doesn't mean, of course, they're going to move all of their holdings there. Of course not. But it becomes interesting to them to actually have a small allocation in their portfolio that gives them exposure to that kind of products.
Right, but the yield in DeFi is coming from the people who are speculating within DeFi, right? Like there's always the other side of the yield. So the people who are leveraging up positions, who are trading within the decentralized finance ecosystem, who rely on permissionlessness to be able to get the access to the funds, and will pay for that. So how do you bridge a permissioned pool of people who are yield seekers, institutions, to the people who are actually paying the yield, which is mainly in the permissionless DeFi space? Because if you're saying majority of the clients are people who are yield seekers, they're capital providers, and the most people who are providing that 20% per annum are people who are acting within the permissionless space and don't want to do KYC AML, how do you bridge those two worlds together?
So actually, it's not the case, right? Because you have quite a few now I mean, we've seen how markets have been behaving, but what we call speculative trading, but they are institutions.
Mm-hmm.
So they are institutions that are registered, that have their offices, etc. These are the biggest player in the borrowing and lending market at the moment. So if you're able to offer them, as you can guess, the yields are going to be lower in this space than in the fully decentralized space. So if you're able to decrease their yields and offer them a pool of liquidity that is larger than what exists at the moment,
So
it's a no-brainer for them.
decrease their borrowing costs, you mean?
Yes,
Yeah.
decrease their borrowing cost. It will become also is a non-brainer for them to head there. But the end vision is actually to be able to merge the two. But in order to merge the two, as you can guess, it will take some time and it will take some education on both sides of the spectrum. Like right now, we know there are institutions that are comfortable with this concept of trustless KYC AML. And now we want as well crypto traders to become comfortable with this concept of trustless KYC AML, where you tell them, you are the one owning the data and you are the one giving the okay for this data to be sent or not. And as anything new, especially when it comes to privacy, when it comes to transparency, when it comes to anonymity, you need a little bit of time and you need a little bit of trial for people to trial it and see that it's actually something that works. But there's one point I want to highlight is there's quite a big conundrum, I would say, in the industry between more transparency means less anonymity and more anonymity means less transparency. But it is not the case. You can be anonymous and transparent at the same time, right? And this is what the Trustless KYC AML is all about.
Walk me through that.
Sorry?
Walk me through that. So, like you say that the trustless KYC is about transparency and anonymity. I mean, the problem with transparency on blockchains is often the concept of pseudonymity, which is like, I don't know who these people are until I've identified that you own a wallet address. And once I've identified you own a wallet address, I'm able to see all of the transaction history you've had, which is like the age-old debate between, sort of full-on ledger information and traceability, which is why, regulators are getting more comfortable with things like Bitcoin, but aren't comfortable with things like Monero and Zcash. But the idea of trustless KYC means that you're not handing across personal information to everyone in a pool. I get that, but you're still able to. If I work out that that's your address as an institution, that's your address, I can still then go back and see all your transaction history, right?
Yes, but here we're talking about KYC processes, right? Not necessarily about the transaction history. We're talking about KYC processes, which is the main pain point for institution to come into one of the main pain points for institutions to come into these pools. Let's say you're an individual like me, right? You want to enter a pool, and if someone comes into a pool and that someone will need a requirement from you to divulge your KYC AML status, you will know that. So you will make the decision to disclose or not disclose. And if you don't want to disclose, you can step off, right?
Mm-hmm.
And same thing, you want to enter into a transaction. If you're entering into a transaction with a party that needs disclosure, before you do this transaction, you will know this party will require disclosure. Are you comfortable disclosing? Yes or no? So that's the way you see it. So if you don't want to share, you don't share. If you want to share, then you can share.
That's really interesting. Like it's sort of similar stuff, but we've spent a lot of time like diving into as well, just because I think that this idea of permissionless, permission DeFi on top of permissionless infrastructure, where there's no reason that a DeFi application can't be permissioned in some way while still being on top of permissionless infrastructure. I strongly believe in public permissionless infrastructure because of the reliability and anti-fragility of it, right? But there is still like regulatory requirements that mean that you want to ensure, for example, like KYC AML. The tricky bit that we always found in sort of like when you go deep into the regs is around this idea of reliance. So there's two forms of this. The first is there's identity-based AML KYC. I know who you are. I've looked at your background. Your PEPs and sanctions are fine. And then there's transaction-based AML. You've done a particular transaction. Is that okay? And then from the point of view of like AMLD 5D, the sort of the European regulatory standards, the reporting requirements being that if there is money laundering, how can you actually go and prove to the regulator you did the checks that you needed to? And often that actually requires you going and requesting the information. You actually need to get the information, show you've done the checks, both on the transactions and on the individuals. And like, how does that practically work from the point of view of a trustless environment? How am I relying on the trustless regulatory compliance person to the point where I have actually legally delegated my AML responsibility to them? And are they legally taking that responsibility on from the point of view of regulatory compliance reporting?
So then it depends with countries. In the UK, for example, the responsibility, if you're a bank, the responsibility falls on you. But most of the time, having been in a bank, most of the time what happens is that the KYC AML will be done by a third party.
Mm-hmm.
And that KYC AML would be approved. And there's a continuous monitoring. I think it's every 3 months, depending on the tiering of the client.
Right.
But the responsibility in the end falls on you, and this is a risk that a lot of the banks, are taking and are willing to take. And this is why when we were initially talking, I told you there will be a pool. We will start with fully institutional on the side and fully decentralized on the side, and the idea is to bring them together in the future, because there's a lot of learning on both sides of the spectrum.
Right.
We need to make retail or crypto enthusiasts comfortable with understanding what these checks are and understanding where this data go and where this data sits and how this data is going to be used. And at the same time, you need to make institutional comfortable by understanding that DeFi is not about money laundering and is not about terrorism finance. Right. And so this is why you keep them separated initially, and then you bring them together.
So let's talk about your first products you guys have launched. I know that you've recently launched Liquidity as a service. I think you guys have got like $20 million in the first month, which is amazing. So can you talk a little bit about that service and how it works?
Yeah, so the idea basically came from the fact that we have organized, or we had to build our own liquidity pools, our own staking pools, and we wanted to create like a very easy access platform with analytics that allows us to see, how the pool is performing. But at the same time, for our users, we wanted them to be able to know how much impermanent loss they suffered, how much returns they're making, and all of the sets of data that you need to actually analyze your investment. Because as you know, when you go and invest in a liquidity pool or in a staking program, usually you don't have this data. So you calculate it manually, or then you need to download tons of unstructured data from various outlets and try to figure out actually what was the return on this investment that you made. And so initially we were building that for us and our community, and then we saw that actually there will be a lot of demand for that, because it took us a little bit of time, right, to decide what to put in, to decide how to, frame it and build it. And so we decided to offer it as a white label solution for any project, basically, that want to launch a liquidity pool, that wants to launch a staking program, and give them a, how would you call it, a all-in-one solution, or one step solution for this.
So when you say launch a liquidity pool or a staking program, are you talking about stuff that's on Ethereum? So like launching one on Uniswap or on SushiSwap?
Yeah, so right now we have it on Ethereum and we have it on Binance Smart Chain, and it should be extending to the other blockchains as well, like the Polkadots of the world.
And the idea is to make creating these programs easier. So if I wanted to create a liquidity program, it's kind of got all of the things I already need in there, all of the smart contracts and everything.
Yeah, everything is in place for you to. It's just literally plug and play. You just go in there, you just put in what you want, whether you want it on this chain, on that chain. What is the tenor, or what is the maturity of the? I speak with. Clearly, I'm a bond person. What is the tenor? What is the maturity of the pool? How much are you paying?
Right.
And all of the monitoring tools that you need from a protocol point of view, i.e., you're the one setting up the pool, setting up the staking programs, etc., but also for your users from an analytical point of view.
Okay, cool. And what kind of projects have you got using it so far?
We got a few. I think we are at 5 project now.
Hmm.
I think the first one we did. No, I think the first one we did with DAFI protocol, which was, yeah, our first client, and there's 4 more that have been announced or should be announced soon.
Okay, and what did you say DeFi?
DAFI.
DAFI. What does DAFI do? How are they using the service?
Well, they wanted to create an ETH liquidity pool
Okay.
and then an ALBT DAFI liquidity pool. Oh, there's one thing also I forgot to mention. One of the positive thing about this, or at least at the start, we're trying to merge communities, right?
Right.
So if they want to do the, let's say, DAFI ETH liquidity pool, of course, that would be the main one. But
Mm.
also, what we're doing is we're encouraging both communities to sort of co-invest. So you create an ALBT and partner liquidity pool. So we
Right.
did
Right. Right.
ALBT, that fee liquidity pool, and that allows both communities to come and get introduced in a way to new project and provide liquidity into new projects as well.
Interesting. So you guys have got a token.
We do.
Let's talk a little bit about tokens. Why did you guys decide to do a token? What does the token do?
Well, the whole protocol works on the token. So the utility is basically, it is the currency of the system. It is at the same time, or will be, the governance of the system. Our governance, so we will probably have separate governance token that will be a consequence of what we call calibrocracy, meaning your vote in the system will be weighted by your reputation, and your reputation will be a proof of your work, a proof of your capital, and a proof of your authority, meaning a proof of your knowledge and your involvement within the community. And here you will have the token playing a big role, but at the same time, in all of the products, I mean, we're launching a decentralized exchange as well. Within the decentralized exchange, similar to what you have in Uniswap, the token will have a main spot to shine. Let's put it this way.
Okay. Okay. So and when you say it's the currency of the platform, as in if I want to launch a liquidity pool using Alliance Block's platform, I have to pay for the deployment of it using the token, or
Yeah, so you don't pay for the deployment. Basically, what we're doing now, you need to stake in uh,
hmm
a small equivalent of ALBT.
hmm
I believe we started at 30,000. So you will stake it in, but I mean, of course, you own it, so you can, if you want to exit and you don't like our token, you can do that. But yeah, the idea is to make sure to give the most usability to the token within all of the product suite that we have. Similar with the data tunnels, with the data API, with the exchange, with the bridge, all of that uses the token.
got it. Okay. All right. Very interesting. Now exchanges. Last time I spoke to you, you guys were teasing this idea of creating a decentralized exchange without impermanent loss,
With
which is
minimal impermanent
with
loss.
minimal impermanent loss, which is a really intriguing concept. So I understand you guys are now in testing. Um, can you talk about, so first of all, like just give me a little 101 on what impermanent loss is, and then as much details as you can about how you guys are minimizing that.
So basically, impermanent loss is a type of negative convexity that you have in liquidity pools that is due to the volatility of the underlying assets or the volatility of one of the assets within the pair. And I'm sure everyone has experienced it, and sometimes it can be very, very painful. In a way, the idea of offering yield or offering rewards on new liquidity pools, i.e., liquidity pools that are using new tokens, derives from the need to hedge this impermanent loss, right?
So what do you mean by convexity?
By convexity, meaning so it performs as a negatively convex asset, meaning the higher the volatility becomes, the higher the losses on one of the pairs become. So let's say you have one pair that is very stable, and then you have the other leg of the pair that is very volatile. What would happen is, let's say you put 1 to 1, yeah. Let's say you put a total of $2, and that the pair is worth 1 to 1. If you have one leg that increases by 50% in one go, what would happen? You will have 50% less of the pair that has increased and 50% more of the pair that has decreased. And so this can lead to this impermanent loss, which is due to this negative convexity that the algorithm has, which basically, in an easier way, is a type of mark to market of your position. Meaning that if the pair goes back to where it was, minus fees and some extras, normally you should go back to the same mark to market, to your initial mark to market, your initial position. But now, of course, DeFi being a very volatile asset class, you can imagine then on a daily basis or on a weekly basis, you could have big valuation drops within your position. And so what one solution that people have found was to create this very high yields of 50%, 100%, sometimes 200%, in order to cover for this extremely high volatility in the market, in your mark to market.
So this is just going back to how constant product continuous function market makers work, right? Which is like this idea that the price that you pay is the ratio between the two assets in the pool. So as you say, if I have 1 unit of assets here and 1 unit of assets here, the price between these two assets, asset A and asset B, is 1. But because the product has to be constant, meaning that if I multiply the number of assets in one side by the number of assets in another side, that gives me my constant. If I take some out of one side, I have to add enough into the other side to keep the product constant. Because it's a multiplication effect, you end up getting this curve. And what you're saying, convexity, is that if the price increases rapidly, what's actually happening is that someone is paying, let's say that the price doubles instantly on all markets apart from Uniswap. Now, and it started off at 1 to 1, and now it should actually be 1 to 2. To move the price, someone's actually paying each of those steps. And so what they're doing is they're buying it under value all the way up until the point that it gets to 1 to 2, meaning that the price, the aggregate price they paid, approximately is half the sticker price of the endpoint. So I've paid 1.5 per unit instead of 2 per unit, which was the end price. And that, as a result, is a negative, like people are making money off the fact that they're buying assets cheaply off me. And as you said, like when you have new tokens and you say you got USDC, that's always going to be $1. But a new token could go exponential, and the faster the exponent is, the more you end up selling your assets cheaply on the way to getting the price to parity, which is why people don't like impermanent loss, right? So what is your system doing to stop that from happening or reduce that from happening?
That's the £1,000 question, or the 1 million pound question. We will release a white paper with the full details, but I can tell you. So we presented the results at Consensus, and we did a comparison with a balancer with various weights. We did a comparison with Uniswap, and the results were very impressive in terms of being able to minimize this impermanent loss, and also showing a quite symmetric, very very nice symmetric profile. So this is for us. So we're going beyond just hedging this, or minimizing this impermanent loss, because what we also want to do is single staking, i.e., the second version of the exchange will allow you to just offer, like, let's say it's an ETH BTC pool.
Right.
You will only be able to offer ETH rather than being forced to offer both side of the pair. And as you can guess, this also can have quite tremendous or quite interesting results in terms of managing your portfolio value, because sometimes you're long ETH but you're not necessarily long BTC, and you're forced to buy BTC to participate in a pool.
Sure.
But
This is what Bancor does, right? Bancor's single-sided asset pools, which the Bancor V, well, it's now 2.2, 2.1. But yeah, they do single-sided asset pools. The way they do it is they use an oracle. So they use the concept of endogenous and exogenous price variables. So like if the market is like if I have an oracle and my oracle price is telling me that the major market, Binance, has substantially moved and my local market hasn't, then instead of taking the price as the ratio between the two pools, I take the price as the ratio of what the oracle indicates it should be. However, if someone trades across my pool, I know that my internal market has moved versus oracle price, and so I should keep a diff against the oracle price until someone comes and trades against it. So I'm not removing all arbitrage opportunity. I'm just like hedging against massive moves off market. The downside of Bancor model is that you have to accept you basically have to accept BNB tokens as the way in which you get paid out any impermanent loss against any pairs that are traded against, which they then will trade into your asset class if you want it to.
But I believe they let you trade they ask you where to trade within the curve, right? So you need to specify at
Not
which
for
price.
Balancer. That's for Uniswap v3. But Balancer is just it's a Balancer. Bancor is just I'm providing one asset and that's it. But I have to accept BNB to hedge my impermanent loss, and I also, which is their token, no, not BNB.
That surprised. I was like, oh, why Binance?
No, not Binance. Bancor, whatever the Bancor Bancor BNC, you have to accept the Bancor token, and you also have to pay a little bit of your yield to cover your impermanent loss. But yeah, like but it only works for tokens that have major market off market, so that you can assume that the market that is on Bancor isn't affecting the market that's off Bancor, or that there isn't too much circularity of reference based on the oracles. There's some other stuff that I've sort of seen as interesting, is this idea of like the momentum. You can change the price more quickly based on the amount of momentum that's going into price. So like if I'm seeing, if I locally are going, okay, well, this price is rapidly moving away, I'll move the price faster than the ratio of the pairs dictate it, and then that would reduce my impermanent loss as well. But like all of these things have got then the secondary aspect of what's the game, because like often what you do when you this is like a personal geeky point for me. I really enjoy this whole like area of finance, but the thing that you often see in these models is a lot of people approach these from a purely quantitative point of view, where they assume that they can bound the system. They can say, okay, I can assume that I assume that I can state categorically what a rational economic action is by an agent in the system. And often you haven't got full information. You never have full information in economics, as you know this very well. So what you think is the Schelling point for the system turns out not to be. It turns to be something else, and that what you think is the rationally bound action turns out to be something else, and the system breaks as a result of that, which is like what happens with Fei, for example, or the stablecoin and a few other things. So I'm really interested to see the paper. In fact, I would love to when it comes out, read it and then have a discussion about it, because I think
I will send it to you. I'm sure you will be very happily surprised.
Okay, cool. Okay, so no more information for the time being, and if you guys are using momentum-based indicators, I'll be very happy. And then this last thing, just before you go, like data tunnel. You've mentioned data tunnel a few times. What do you mean by a data tunnel?
So the data tunnel is basically it aims to become the oracle of oracles. We have quite a few partners, to be honest, but the aim of being an oracle of oracle is again the fact that you have not only blockchain data, right? You have a lot of real world data that needs to be monitored and that needs sometimes to be enhanced. So, I mean, my business is financial markets, right? So the way I look at it is from financial market perspective. You can have access, let's say, to data from Bloomberg or data from Refinitiv, and then this data can come in on there and this data will be enhanced. So we will add to each block of data any other derivation of this data. We just enrich this data and then we send it back. We send it back to the system. And this came from the fact that, again, like data is very fragmented and sometimes being able to track, maybe this is not the correct word to say, but being able to link and track each data point with those data points that are related to it is not an easy thing. Is not an easy thing to do. And beyond that, what the Oracle of Oracle also allows you to do is to monetize the data that you're putting into the system. So this data will be sold in blocks. So it's a data monetization platform as well. That the data that is inputted and data that is outputted will allow you to generate revenues on the data that you're putting in. And so this, as you can see, can add some revenue stream to some of the, I would say, medium tier 2 data providers that don't necessarily or that only sell data with licenses, that would allow them to start monetizing it within a different revenue stream and like selling pieces, basically selling pieces of data to usually consumers that they wouldn't have had the manpower or the operational power or the marketing budget to access.
Interesting. Really interesting. I mean, another huge problem for the crypto space and the decentralized finance space. So really interesting that you guys are doing that too. So Amber, it's been such a lovely pleasure speaking with you, and thank you so much for taking the time for coming on. If people want to find out more about Alliance Block, where should they start and where should they go?
I think our Telegram group is very, very helpful. So I would advise everyone to join the main Alliance Block Telegram group. You can find the link on the website. And then we have quite an...
So the website is allianceblock.io. That's ALLIANCEBLOCK.io.
Correct.
And it's just really easy to find, isn't it? It's like the Telegram handle is, where is it? I actually can't see it on your website immediately. Where would it be?
That's a good point. So the Telegram handle is Alliance Block.
Just Alliance Block on Telegram.
INCEBLOCK.
Okay, Alliance Block on Telegram, or one word. Cool. All right. Oh, no, there it is. It's right at the bottom of your page. You've got a little thing saying Liquidity Mining, and then there's all your links, and the first one is your Telegram link. So, wonderful pleasure. Thank you so much for coming on, and wishing you guys all of the best for all of your launches.
Yes, and we're keeping a close eye on what you guys are doing, because it is in itself revolutionary. So really looking forward to see this come through as well.
Thank you very much. Thank you.